AI itself doesn't only demand electricity and the storage of the data, but a chat GPT query takes 10 times more energy to get the answer to than a Google search. So we've got this big shift to AI right now, and just that in itself is going to require a lot more energy. So I mean, I could go on forever talking about this stuff, but maybe there's some other things you'd like to talk about as well.
The younger generation that has not seen the inflation rates that we're going through, obviously in their lifetime, or they were very, very young and don't remember, didn't have any bills.
That's right.
But obviously, people are feeling optimistic because, we've seen interest rates go a little bit down. Can you talk a little bit about what your perspective is or what your forecast is for inflation? Because I don't feel like we're going back to where we
Yeah,
were.
I completely agree with that. And it's interesting. You've got the Fed and other central banks cutting rates, and yet the larger economies are nowhere near this sort of universal 2% target. We're still really much closer to 3%, and yet they continue to cut. I don't know about you, but I have not seen the data that shows that we're clearly they'll say it. They'll go out and say it, and the Fed governors will go out and they'll say, we see that we're clearly on track, towards 2%. Um, Again, I have not seen it, and yet they keep cutting. We saw this before. None of this is new. This happened in the 1970s, and in the 1970s there were three big waves of inflation. And in fact, I've got charts where these line up almost perfectly time-wise in terms of the number of years that they took to play out. And I have one chart that shows that this first wave, that one that happened in the late 60s and early 70s, it ran up. What happens is you get central banks, step in, people start screaming about inflation, the central banks step in, they start raising rates, and the economy cools and the rates come down. Sorry, the inflation comes down. Well, it comes down, but it never comes down to the pre-inflation levels, which we know, say prior to 2019 or 2020, were almost at zero in some cases. The Fed, eventually got really hard what it said it wanted so badly, which was inflation at 2%, eventually went to 9%. So what happened in the 1970s was, as I say, and as we've just experienced, central banks start raising rates, it cools the economy, the inflation sort of dials back, but it does not dial back to levels that were pre-inflation or pre high inflation. It dials back, but it reaches a new trough that is higher. So in other words, right now, what I'm seeing is that we've seen inflation kind of pull back to about the 3% level. I think that the 3 to 4% range is going to be the new 1 to 2% level. I think these are going to be the new lows. And what happened in sort of the early part of the 70s was you had this trough, and then you had things like we just talked about. You had tariffs, you had higher wages, and these started to push inflation back up. And the second wave of inflation peaked at a higher level than the first wave. So we're lining up for that as we are right now. And it's likely that, based on sort of the timing of what we saw in the 70s and how this is lining up, I think we're going to see a bottom in inflation.
The hedge against inflation is assets and commodities. I kind of feel like silver, for again the younger generation that's not used to this, is like the gateway metal into getting into commodities. So can you just talk a little bit to investors that are new to this whole scenario of how silver can be a great hedge against what's the second wave coming that you just talked about?
Sure. So, Kelly, first of all, I love your term there of gateway metal. I think that's fantastic. I'm gonna use it. So
Please feel
I'm
it.
already I'm already telling you now that I'm gonna use that. It's too good. So yeah, I mean, if you look at silver, it becomes the natural alternative to gold, and everybody knows gold, and even people who maybe I shouldn't say everybody, but a lot of people know and understand gold, even some of the younger generation, what it's what its purpose is, and it's very little of it is used in industry. So most of it is an investment, and most of it is both a safe haven and a protection against inflation. And it does that job, and I'm going to say in some periods of history of time better than in other periods. Well, but when it does it and it does it well, you definitely want to own it. And I'll give you a little example. If you look at what happened in late 2022, the so-called, 60/40 portfolio of 60 stocks, 60% stocks, 20% bonds, because inflation ran up so high into mid 2022, that portfolio had its worst returns in something like 100 years. And so Wall Street loves to tell everyone, this is the standard, this is what you should own, and this is how you need to split your assets, and if you have a long-term view, and on and on and on. But that I think is unlikely to be the case over the next 10, maybe 15 years. And in fact, you've got banks, big US banks like JP Morgan, saying things like that are agreeing with that. And they're saying things like bonds are really, really going to struggle. I mean, if you just understand quickly that bonds um, move inversely with interest rates. So if interest rates move up, bonds that already pay a certain coupon will compete with higher rates. So they will go down in value because you can get a better return in a newly issued bond that now pays a higher return because interest rates are higher. So just understand that it moves inversely to interest rates. So if inflation continues to move higher, bonds will continue to struggle. So, and banks like JP Morgan and others see this and they're saying that, maybe your bond portion of your 60/40 portfolio needs to be readjusted. Maybe it shouldn't be so bond heavy. If anything, if it's going to be bonds, it needs to be a smaller portion than 40%. It probably should be closer to maybe 10 or 15%. It should definitely be short-term bonds, which are less affected, and you can renew them at higher rates as rates go up. So you've got that advantage. And for the balance of that 40%, you really should be looking at hard assets. You need to be looking at commodities and, in fact, the entire commodities complex. So I would completely agree with that. I think we're going into a decade or more of a very, very powerful bull market in commodities. And so that's where people need to have some focus. I even have my doubts about the 60% stocks part of the portfolio, but let's leave that aside for now. To get back to silver, you talked about the gateway to investing in resources and precious metals in particular. Well, silver does well and it outperforms gold in bull markets, but it tends to do that more later.